Hey, my name's Rajesh. I'm a multifamily lender in Los Angeles, specializing in 2 to 8 unit multifamily buildings. I'm also an investor, and today I wanted to talk about something just a little bit different. I wanted to talk about purchasing a multifamily building, but not just as an investor, but as a resident. So imagine you are renting an apartment in a 4-unit building and the building goes up for sale. You know what's going to happen. Your rents are going to go up in order to cover not only the debt payments and the operating costs, which were there even before the debt payments, but the added profit on top of those debt payments. So let's say you did not want to have to deal with that. Rather than dealing with increased rents and not being able to save up to buy your own place, what if you partnered with the other residents to do a co-buying? Like you guys just partnered up and said, let's buy this building ourselves. And even if your monthly payments go up because now you're servicing the debt and paying property taxes and insurance more directly, you get to also benefit from any of the equity appreciations as a group. So let's see something that's more typical here. Like let's see this $1 million building with 4 bathrooms. This is 2 homes on 1 lot, so that means each home is $500,000. Let's see something like this: 3 baths. I'm looking for 3 to 4 bathroom 3 to 4 unit buildings because I think the leverage there is better. Okay, so this is 5 baths. So this is a permitted ADU. So this is 3 units right here. And let's see how much that is going for. $2 million. Yeah, that's more of a full home sort of deal here. Not really a multi-family. This is a duplex, so again, not really relevant to our search. This one might be interesting. It's 9 baths on the higher end. This is an 8-unit building. So that's a little bit trickier because when doing that, you cannot get like a normal FHA loan or a conventional owner-occupied loan. And we're looking for situations where we can get that owner-occupied loan. Okay, so here's a quadruplex. It's in Los Angeles. Lot size 4,300, LAR 4. So this is the 4-plex that we've been looking for. It's $1.2 million. And let's see what the rents are right here. About $2,200 a month. So when doing something like that, let's say each family is earning about $40,000 a year. Well, actually, let's do something like this. Median income in zip code . $44,000. So I said 40,000. Okay, so that means 4 households here because it's a 4-plex. So 4 times 40 is 160. Oops. And 0 monthly rents because it's going to be owner occupied. And that means the max loan amount that they can afford on an FHA is you can see it right here. This says max home price $874, but that's based on a down percent of 3.5% or max LTV of 96.5%. Let me zoom in so you can see that, how this calculator works. It looks at your monthly income, or rather your yearly income, even if this was your yearly income. And based on that, it figures out your DTI. So DTI stands for debt to income ratio. And assuming you have zero other debts, let's see what this looks like. 1.199 times 1.25% is $14,987 a year. 1,487, let's say 988 to round up. Annual insurance would be closer to 2,000 actually. And let's say total debts among them are about 3,000. Okay. That property tax feels wrong to me for some reason. 1.2 times 1.25%, 15,000. Yeah, that's about right then. Interest rate. I just priced one of these out recently. A multifamily on an FHA loan, you're looking at about 5.25%. But let's say they don't have any money for closing costs. So by increasing the interest rate, they get some credits towards that. And now let's say with some seller credits thrown in there, they have zero closing costs. That means their down payment's about $15,000. So $15,000, right? $15,611 divided by 4 families. $15,611 divided by 12. Or rather 4, sorry. They're going to each have to put up about $4,000 as a down payment. This funding fee, the upfront mortgage insurance premium, let me scroll this up here. So your max LTV is 96.5%, minimum down payment is $15,611, and your upfront mortgage insurance premium on an FHA loan is about $5,000. That we can roll into the loan. That's not a problem. This says max home price of $302,000, but that's assuming a max LTV of 96.5%. The down payment is really anything that's really the difference between the purchase price and the maximum loan amount. So what we really need to focus on here is the maximum loan amount, which is $292,000 right there. Let me see, let me make sure this is working. So this says a front end DTI of 24.4%. What happens if we get rid of these debts, the $3,000 in debts? Is this monthly? Yeah, this is definitely monthly, I believe. Let me see here. How is this calculated? Yeah. So that is monthly. So I made a mistake here. Let me fix this formula really quick. And divide that by 12. Now if we put in 3,000 there, now we get a more realistic maximum home price. And that means maximum loan amount is $728,000. So 1.21199 minus this maximum home loan amount, which means they have to come up with $470,000 as a down payment amongst the 4 of them. Divide that by 4, so they have to come up with $117,000 amongst the 4 of them. And let's see what their monthly payments will look like. They're looking at total monthly payments of $6,000, right? And that includes, as you can see here, property taxes, mortgage insurance, and hazard insurance. So their rent would actually go down because the median rent here, or rather the average rent here, is $22.67 a month. But you take that 6,003.33, divide that by 4, and now you got each person paying $1,500 a month. And yeah, every year that's going to go up, but not because of this, but because of these two items right here, which are property taxes and hazard insurance. Now, they're lucky that they're in California, so there's a limit as to how much property taxes can go up every year. But hazard insurance, that changes. I mean, we've seen skyrocketing homeowners insurance because of the fires here. They're pretty drastic increases. And to the point where if you put income or caps on how much they can increase every year, the insurers just don't insure the buildings. And part of getting a loan is ensuring that you have adequate coverage in terms of insurance. So let's say the situation is not realistic, right? Let's say saving up $110,000 or $120,000, right? So we were at 1,199, 123 minus 728,888.08, 470 divided by 4, 120,000 approximately, 117,000. Let's round that up to 120 just to be good. $120,000 per person may not be a realistic savings goal, but let's see how much they would have to earn in order to lower that down payment. Because when you lower the down payment, you're actually increasing the loan amount. And when you're increasing the loan amount, you're increasing the monthly payments because you still have to pay it back within that same period of time, which in this case is 30 years. So let's say every person living here let's say the husband and wife are both working and they earn a combined $80,000 a year. Each person in that household is earning $80,000, and they're only couples living there. Some may have kids, some may not, but they're all couples and they're both working. So they have a combined household income of $80,000. So let's just do some quick math to even see if that's even realistic. 80,000 divided by 12, that's $3,333 a month, divided by 172 hours, that's full time, work in a month. So that means they're getting paid $19 an hour. So let's say they're getting paid that, but now it's a husband and a wife doing the work. So that's $80,000 per unit. So 80,000 times 4. That's $320,000 income here. 320. Okay. Now look at the maximum loan amount, 1.72 million right here. Right? That's $1.7 million, $1.72 million. Taxes stay the same, insurance stays the same. The only thing that changes is the income. And the interest rate is 5.75, again, to cover closing costs. So let's see what kind of down payment they would need. On a $1.2 million loan, and I'm just rounding up for nice round numbers here, your max LTV is 96.5%. 96. Actually, let's pull up another calculator. That'll make it really easy. 96.5%. And here are all our closing costs. So origination fee would be 2%, seller credit. Let's say they get 3% seller credit so that they get $34,000 in credits towards closing costs. So our origination fee, if you look here closely, would be $23,000 just for doing the loan. But you see the total cost, which adds up this section combined, is negative $9,000. And that's because you get seller credits in the form of seller concessions. Let me scroll this up so you can better see it. Seller credits here. We are asking for 3%, and that means $35,000 as credit towards closing costs. Third-party costs, this $34,000 can also be applied here. So what you're going to notice is the total third-party costs adds up to roughly $11,000. That's all of this. That includes the appraisal, credit report, title and settlement, recording and transfer fees. Prepaids are basically the prepaid interest between the time of closing the loan and the first month's payments. Assuming you close on the first of the month, you don't have to make payments for the first full month, and your payments start the next month. It's just a guardrail so that we make sure that we do not exceed that total third-party fees exceed this. And again, this is not an official loan estimate. This is just a rough estimate calculator. Okay. So let's say each apartment earns about $80,000 a year. Husband and wife both working, $20 an hour, full time. I don't think in Los Angeles that's unreasonable to expect. Their monthly payments are going to be just P&I, principal and interest, $6,389. We're going to come back to that later, and this is at an interest rate of 5.25%. So they're not getting any lender credits towards closing costs. It's coming straight from the lender, and it's coming straight from the seller. So that means they get the lowest interest rate of 5.25%, assuming their credit score is there. And I'm going to say like a credit score of 680 to 700. And this is not the APR, by the way. Your APR is down here, which rolls in the total cost of the loan, which includes the origination fees and third-party costs, into the interest rate. And I keep forgetting my head is blocking this. So at a 5.25%, with the way we price our loans, they're looking at an effective APR of 5.3%. But this cash to close is what I want to focus on. $43,000. So 4 households earning $80,000 a year, that's 43,754.84 divided by 12. Or not actually divided by 12, I'm so used to dividing by the year. 43,754.84 divided by 4. So each person has to come up with $11,000 for closing costs. That includes the down payment and maybe some excess leftover closing costs. So I'm looking at, you got negative 9,000 here and 11,000 here. So that means if you look at the bottom right corner here, it tells you the sum. That means your total closing costs after seller credits is about $2,000, $1,789 to be exact, plus the down payment. So let's see what the down payment is on this loan. Times 335. $41,000. That's your down payment. $41,965. So let's say $42,000. That's your down payment. Split 4 ways. So this is what I wanted to get into now. This is just principal and interest. $63.89, right? $63.89.19. And now we want to also see what the mortgage insurance, property taxes, and hazard insurance would be. Mortgage insurance is calculated at 0.55% of the loan amount. So in the case of an FHA loan, you're looking at a loan amount of $1157,035. But I forgot, you're also adding in the upfront mortgage insurance premium. So we got to multiply that by 1.175. Is that right? Yeah, that's about right. So 1.35 million is the actual final loan amount, I believe. Let me just do this one more time. Times 0.0175. $20,000. Sorry, I had done that wrong. I did do that wrong. 20,248 is your upfront mortgage insurance premium that gets rolled into the loan amount, plus 1157035. So your new loan amount, your total loan amount, actually, that does not make sense. Yeah, that's not making, oh yeah, that is making sense. Okay. 1.177 million. So now we can multiply that by 0.55%, which gives us annually a mortgage insurance premium of $64.75. $64.75 divided by 12 is equal to $539 in mortgage insurance. So $539.58. Add that to the 6389.19, and now we got to get the property taxes, right? So your property tax is based off the purchase price times 1.25%, 14,987.50. 14,987.50 divided by 12 is 1248.96. 1248.96. And now the home insurance. I always figure home insurance on 4 units and below is somewhere around $1,600, but let's be conservative and say $2,000 a month. Let's see what we were using here. $2,000 a year, sorry. We were using annual insurance of $2,000. So $2,000 divided by 12 is 166.67. So this total is 8344.40 equal to sum. There we go. 8340. Now divide that, 15 divided by 4. Each person is paying $2,086 a month. That's $2,100 a month. Now, let's be honest. Some of these people are probably paying less than $2,200, and some are paying more. But I would argue they're better off buying this building than saving up to buy their own house, one. And two, because they're better off because the rent's going to stay fixed. As soon as somebody buys this building, they're going to increase the rents if they don't have a year lease in place. Now, it might go up 5 to 10%, anywhere from 5 to 10% per year. And every time it comes time to renew the lease, the landlord is going to increase it 5 to 10% in order to maintain the value of the building so that when they sell it in 10 to 15 to 30 years from now, they get the full market value of the building rather than getting a building that is so far below market rents that nobody wants to buy it because it's going to be impossible to get them up to market rents without just completely evicting the tenants and doing major rehab on it. And that's assuming we have the current laws in place. So it doesn't make sense for the renters to allow somebody else to buy this building. They should buy the building themselves. The other benefit of this is that they get to benefit from the equity appreciation of the building. So what does that look like? Here is their Uh, Here's the purchase price of the building: $1.199, almost $1.2 million. Compound interest calculator. There we go. And initial investment is $199. Monthly contribution is going to be 0. Let's say 30 years. Estimated interest rate. In LA, let's see what, I'm guessing between 8 to 10%. But let's see what the internet says, so you guys don't think I'm pulling numbers out my ass. Annual home appreciation rates in Los Angeles past 30 years. $8.62%. I was going to say 8%. There were years that exceeded 15%, and there were drops as big as 37% in 2008. So overall, that averages to 8.62%. I'm going to be conservative and just say 8%. Let's just keep it there at 0. Compound it annually. Calculate. So in 30 years, they're going to be owning a building that costs $12 million. This is what they can pass on to their families. So if you're a renter and your household earns $80,000 a year, let's actually do the breakdown on that, right? That's $300,000 per unit. So they're buying a home, a permanent home, I didn't say house, home, for $300,000. So this is very doable. And the only real cost increases they had to worry about are property taxes, which fortunately for them, they live in California. And as long as they don't remove Prop 13, the limits on increases every year on the property taxes are pretty controlled, unlike in other states. But the real worry here will be the insurance. That can go up pretty high. But is it going to be higher than regular rent increases every year? And that's also without any of the benefits of equity. So for $10,000 and a decrease in monthly rents, you can buy your building together and owner occupy it, because as long as it's owner occupied, you can get an FHA loan, you can get a conventional loan. For conventional loans for first-time home buyers, your LTV is actually higher at 97%, which means the down payment is even less. So you look at the cash to close here, it's it's $37,000 going on $38,000. Now the interest rate is going to be higher, let's say 5.99. That means your monthly payments are going to be higher. One, because again, the loan amount is higher. Even though a conventional loan does not come with upfront mortgage insurance premium, they still charge private mortgage insurance, or PMI, in the form of a higher interest rate. They charge the loan amount times 1.75%. That's $20,000 every year. 20,353 divided by 12, or $1,700 extra in mortgage insurance every year until you hit 20% equity in the property. And then after you hit 20% equity in the property, the PMI, the private mortgage insurance, goes away. So this is a strategy that you can use as a renter to purchase the building that you live in. If you'd like to see if your building qualifies, hit me up. It doesn't cost anything. I'll just run through a video analysis like this, and you can show it to your to your neighbors in the same building and say, hey, maybe this will work for us. Of course, you have to realize that your neighbors will be living there. And if they move out, they would still own the place and rent it to somebody else, because just because somebody stops living there doesn't mean they give up ownership. So keep those things in mind, and maybe there's a strategy that could work for you.